This lecture focuses on Section 884, branch level taxes, which includes the branch profits tax, the tax on branch interest, and the tax on excess interest. All of these rules revolve around the U.S. trade or business of a foreign corporation. The objectives of this lecture are to understand the following. Foreign corporations that may be subject to branch level taxes, branch profits tax, the impact of U.S. tax treaties on the branch profits tax, the effect of the termination of a U.S. trade or business on the branch profits tax of a foreign corporation, the branch profits tax effect of the transfer of a foreign-owned U.S. trade or business to a U.S. corporation, the branch profits tax effect of the liquidation or reorganization of a foreign corporation that owns a U.S. trade or business, the taxation of branch interest, and the taxation of excess interest. The first question is, who is subject to branch level taxes? In general, the branch profits tax and the tax on excess interest are imposed only on foreign corporations that are engaged in a U.S. trade or business. Most, but not all, foreign corporations are subject to the branch level tax rules if they are engaged in U.S. trades or businesses. See the code and regulations for exemptions that may apply. Non-corporate foreign taxpayers, such as foreign individuals, trusts, estates, or partnerships, are not subject to the branch profits tax or the tax on excess interest. The rules for the taxation of branch interest, however, apply to any taxpayer that receives an interest payment from a U.S. trade or business of a foreign corporation. Note that the branch level tax rules can apply whether the foreign corporation is directly engaged in a U.S. trade or business or indirectly engaged, for example, through ownership of a partnership that is engaged in a U.S. trade or business. Let's look at what types of taxes are covered by the branch level tax rules. Section 884 provides for the following branch level taxes. Branch profits tax, which is a tax imposed on a foreign corporation on the profits of a U.S. trade or business that are deemed to be removed from the U.S. trade or business. That is, profits that are deemed distributed from the U.S. trade or business in the form of a dividend equivalent paid to the foreign corporation. Tax on branch interest, which is a set of rules that treat recipients of interest paid by a foreign corporation-owned U.S. trade or business as receiving interest from a U.S. corporation. Tax on excess interest, which is tax on the excess of the interest allocated to a U.S. trade or business over the branch interest paid by that U.S. trade or business. Here's an overview of the branch profits tax. The branch profits tax, imposed by Section 884, is a 30% tax or lower treaty rate on the dividend equivalent amount for the tax year. The tax is imposed only on the foreign corporation owner of a U.S. trade or business. The dividend equivalent amount is equal to the foreign corporation's effectively connected earnings and profits for the taxable year, reduced by the increase in U.S. net equity during the year, and increased by the decrease in U.S. equity during the year. The branch profits tax is not subject to withholding. The branch profits tax is in addition to the regular U.S. tax imposed on the effectively connected income of the foreign corporation. The tax can be reduced or eliminated by U.S. tax treaties. So what is the purpose of the branch profits tax? The objective of the branch profits tax is to impose the same tax burden on distributions from a U.S. business to a foreign corporation, regardless of whether the foreign owner does business using an unincorporated U.S. trade or business or a U.S. corporation. This objective is accomplished by taxing the earnings withdrawn from a U.S. trade or business by the foreign owner of that business in the same way that dividends would be taxed when paid to foreign shareholders by a U.S. corporation. By taxing the DEA, the dividend equivalent amount, resulting from a net reduction in U.S. net equity of the unincorporated U.S. branch, the branch profits tax imposes the same 30% tax on the reduction of U.S. net equity as would occur through the payment of a dividend. Accordingly, the branch profits tax is the equivalent of the tax that would be imposed as a result of a domestic corporation making dividend distributions to foreign corporations. Let's talk about the dividend equivalent amount. To accomplish the purpose of taxing withdrawals of profits from a U.S. business in the same way, regardless of whether the operation is carried on through an unincorporated branch or domestic corporation, we calculate the dividend equivalent amount, or DEA. The dividend equivalent amount is equal to the net assets deemed to be withdrawn from the U.S. trade or business. In general, if there are profits in a year and the increase in U.S. net equity for the year is less than the profits, then the profits are deemed to have been withdrawn from the U.S. operations, and that withdrawal is a dividend equivalent amount. If there is a loss in a year and the decrease in U.S. net equity for the year is greater than the loss, then profits are deemed to have been withdrawn from U.S. operations, and that withdrawal is a dividend equivalent amount. The formula for dividend equivalent amount is beginning U.S. net equity plus effectively connected earnings and profits less ending U.S. net equity. The terms U.S. net equity and effectively connected earnings and profits will be discussed later. For now, think of them as simply net assets and earnings. Here's an example of the DEA calculation where there is a full reinvestment of profits and therefore no dividend equivalent amount and no tax. Foreign Corporation A has $1,000 in U.S. net equity as of the close of 2017 and $100 of the effectively connected earnings and profits for 2018. A acquires $100 of additional U.S. assets during 2018, and its U.S. net equity as of the close of 2018 is $1,100. Because A's ending U.S. net equity equals the sum of its beginning U.S. net equity and its effectively connected earnings and profits, A has no dividend equivalent amount for 2018 and therefore no branch profits tax. The way to look at this example is A earned $100 during the year and reinvested the entire amount. Since all of the earnings were reinvested, there is no dividend equivalent amount because none of the earnings were deemed withdrawn from the U.S. trade or business. Here's another example where there is only a partial reinvestment of profits, which results in dividend equivalent amount and branch profits tax. Foreign Corporation A had $1,000 of U.S. net equity as of the close of 2017 and $100 of effectively connected earnings and profits for 2018. A acquires $40 of U.S. assets during 2018, and its U.S. net equity as of the close of 2018 is $1,040. In computing A's dividend equivalent amount for 2018, we can see that of A's effectively connected earnings and profits of $100, only $40 is used to increase U.S. net equity. This means that $60 was effectively withdrawn from the U.S. trade or business. This withdrawal of $60 is the dividend equivalent amount, and it is subject to branch profits tax at a rate of 30% or a lesser treaty amount if a treaty applies. Here, A earned $100 during the year and reinvested in the trade or business $40 of it. The remaining $60 is deemed to be withdrawn from the U.S. trade or business, creating a dividend equivalent amount of $60 and a branch profits tax of $18, which is 30% of 60. Let's now compare the dividend equivalent amount rules to the tax results where the same economic transactions described in the previous two examples occurs in a domestic corporation subsidiary of a foreign corporation. Domestic Corporation B is a wholly owned subsidiary of Corporation P. B had $1,000 in net equity as of the close of 2017 and $100 of earnings and profits for 2018. B made no dividend distributions to P, so at the end of 2018 it had net equity of $1,100. Here's the next example. The same facts, except that B paid a $60 dividend to P and reinvested only $40 of its earnings, so that the net equity as of the close of 2018 is $1,040. P pays $18 of tax on the receipt of the $60 dividend. In the branch profits tax cases in the previous slide, the foreign owner of the U.S. trade or business had the same tax result as the foreign parent of a U.S. corporation in the cases on this slide, given the same economic activity. As noted earlier, a reduction in U.S. net equity can increase the dividend equivalent amount for the year. However, there is a limit on this increase. A reduction in U.S. net equity can increase a taxable dividend equivalent amount. However, the increase in dividend equivalent amount resulting from a decrease in U.S. net equity cannot exceed the accumulated effectively connected earnings and profits of the foreign corporation as of the close of the preceding taxable year. Accumulated effectively connected earnings and profits as of the end of the previous year is The aggregate effectively connected earnings and profits for all preceding taxable years beginning after December 31, 1986, less the aggregate dividend equivalent amount determined for such preceding taxable years. Here's an example of the accumulated effectively connected earnings and profits limitation. Foreign Corporation A formed a U.S. traded business in 2018. For that year, it had effectively connected earnings and profits of $100 and a dividend equivalent amount of $60. So its accumulated effectively connected earnings and profits as of the close of 2018 was $40. A had $1,040 of U.S. net equity as of the close of 2018. It has $125 of effectively connected earnings and profits for 2019, and as of the close of 2019, its U.S. net equity has decreased by $50 to $990. In computing A's dividend equivalent amount for 2019, the $125 of effectively connected earnings and profits for 2019 is not increased by the full amount of the $50 decrease in U.S. net equity during 2019. Rather, the increase in effectively connected earnings and profits resulting from the decrease in U.S. net equity is limited to A's accumulated effectively connected earnings and profits as of the beginning of 2019. The increase in effectively connected earnings and profits resulting from a decrease in U.S. net equity is therefore limited to $40, and the dividend equivalent amount for 2019 is $165, which is $125 of effectively connected earnings and profits plus $40 of accumulated effectively connected earnings and profits. The keys to calculating the dividend equivalent amount are the determination of effectively connected earnings and profits and U.S. net equity. So let us first examine effectively connected earnings and profits. Effectively connected earnings and profits refers to earnings and profits determined under Section 312 of the Code that are attributable to effectively connected income. The calculation of effectively connected earnings and profits starts with the foreign corporation's effectively connected income, the calculation of which we discussed in Lecture 3-1. Then we make the same adjustments to this effectively connected income that we would make to a domestic corporation's taxable income if we were calculating the domestic corporation's earnings and profits. These adjustments are provided by Section 312 and will not be discussed here. However, following are special rules for the branch profits tax. Effectively connected earnings and profits does not include gain on the disposition of stock of a U.S. real property holding company and certain other income. Effectively connected earnings and profits is not reduced by the distributions made by the foreign corporation that owns the U.S. trader business. Effectively connected earnings and profits is not reduced by either the branch profits tax or the tax on excess interest that is paid by the foreign corporation. Recall that the branch profits tax is supposed to equal the tax paid by a foreign corporation on the receipt of dividends from a U.S. corporation. The tax paid by the foreign corporation would not reduce the U.S. corporation's earnings and profits. Likewise, the branch profits tax or tax on excess interest does not reduce effectively connected earnings and profits. Here's an example of an item that is a component of effectively connected income, which increases effectively connected earnings and profits in a manner similar to the way it would increase earnings and profits. Foreign Corp is a country X corporation with a U.S. trade of business. The company owns a tax-exempt municipal bond that is a U.S. asset as of the close of its 2020 tax year. There is $100 of interest income on this bond in 2020, which is part of effectively connected income, but is not part of effectively connected taxable income, since it is excluded from taxable income under Section 103 and is not gross income of a foreign corporation by reason of Section 882B. Foreign corporations' effectively connected taxable income for 2020 is $1,000. Because under Section 312, the bond income would be added to taxable income to arrive at earnings and profits, the income is added to effectively connected taxable income to arrive at $1,100 of effectively connected earnings and profits in 2020. Now let us turn to the determination of U.S. net equity. U.S. net equity is the sum of the foreign corporation's U.S. assets less the sum of its U.S. liabilities. U.S. net equity can be less than zero. U.S. assets means the money and aggregate adjusted basis of property of the foreign corporation, which are treated as connected with the conduct of a U.S. trade or business. See Lecture 3-1 for a discussion of assets connected to a U.S. trade or business. For purposes of determining U.S. assets, the adjusted basis of an asset is its basis for purposes of computing effectively connected earnings and profits, which may differ from the basis used in calculating effectively connected income. U.S. liabilities means the liabilities of the foreign corporation treated as being connected with the conduct of a U.S. trade or business. See Lecture 4-2 for the discussion of debts connected to a U.S. trade or business. Let's now talk about U.S. assets. As discussed, U.S. assets means the money and aggregate adjusted basis of property of the foreign corporation which are treated as connected with the conduct of a U.S. trade or business. In general, property is treated as connected with a U.S. trade or business if all income produced by the asset is effectively connected income or would be effectively connected income if the asset produced income. And all gain from the disposition of the asset would be effectively connected income if the asset were disposed of and the disposition produced gain. Property that does not give rise to effectively connected earnings and profits is not a U.S. asset. This general rule is subject to special rules for specific assets discussed later. Here's an example of a U.S. asset. Foreign Corporation A has a U.S. trade or business engaged in trailer leasing. All of its trailers operate exclusively in the United States. Because all of the lease income would be effectively connected income, all of the trailers are U.S. assets. Under a special rule, A bank account may or may not be a U.S. asset depending on how the account is used. In general, earnings from a bank or brokerage account are effectively connected income only if the funds are held for use in the U.S. traded business within the meaning of the asset use test discussed in Lecture 3-1. A bank account would meet this test, for example, if the cash is working capital of the U.S. traded business, where the asset use test is met. The cash is a U.S. asset for purposes of determining U.S. net equity. Earnings on cash not needed in the U.S. traded business would ordinarily not result in effectively connected income, and the cash would not be a U.S. asset. Here's an example of cash as a U.S. asset. Foreign corporation has a U.S. traded business engaged in trailer leasing. The company maintains a bank account holding $150,000, which is used as working capital in its leasing operations. It holds $500,000 in another bank account, which is reserved for contingencies. Only the $150,000 account appears to meet the asset use test and is considered a U.S. asset. Special rules apply for depreciable and amortizable property. An item of depreciable or amortizable property can be partly a U.S. asset and partly not. The percentage of depreciable personal property or amortizable intangible property that is treated as a U.S. asset equals the percentage of depreciation or amortization deductions that reduce effectively connected taxable income. Here's an example of amortizable intangible property. Foreign Corporation B operates a U.S. traded business which involves manufacturing. B is also engaged in manufacturing in country X. Patent A, which is intangible property, is used in both the U.S. traded business and country X. The total amortization of the patent for 2019 is $100. Of that amount, $25 is deducted in determining effectively connected taxable income. Accordingly, 25% of the patent is a U.S. asset. Other special rules for determining whether an asset is a U.S. asset apply to the following assets, among others: inventory, installment obligations, receivables arising from the sale or exchange of inventory property, federal income taxes, lost property, debt instruments, financial instruments, and interest in partnerships, trusts, and estates. As discussed earlier, U.S. liabilities means liabilities of a foreign corporation treated as being connected with the conduct of a U.S. traded business. The rules for determining if a liability is connected with a U.S. traded business, that is a U.S. liability, generally follow the rules for determining when interest is deducted from effectively connected income discussed in Lecture 5-2. U.S. liabilities under those rules are generally determined under Reg 1.82-5. U.S. liabilities are generally determined using the Reg 1.882-5 three-step process discussed in Lecture 5.2, plus the specially allocated liabilities also discussed in that lecture. However, instead of using average U.S. assets and liabilities as required by Reg 1.882-5, the calculation for branch profits tax uses year-end liabilities and assets. In addition, the amount determined under Reg 1.882-5 is decreased when the election to reduce liabilities discussed later is made. Here's an example of a U.S. liability determination. Foreign Corporation B has U.S. assets with an average value of $100 in 2019 and a year-end value of $125. Under the normal Reg 1.882-5 calculation, B determines the ratio of the average of its worldwide liabilities for the year to the average total value of worldwide assets for the taxable year. Assume that this ratio is 55% for 2019. Also, assume it has a ratio of 50% using year-end assets and liabilities. B's U.S. connected liabilities under the normal Reg 1.882-5 rule is $55, which is 100 times 55%. However, for branch profits tax, A's U.S. liabilities are $62.50, which is $125 times 50%. The regulations provide a special election to reduce liabilities, the purpose of which is to shelter effectively connected earnings and profits from the branch profits tax. A foreign corporation can elect to reduce its U.S. liabilities by an amount that does not exceed the lesser of its U.S. liabilities or the reduction needed to reduce the dividend equivalent amount to zero. If the election is made, interest expense on the liabilities deemed to be removed from the U.S. liabilities cannot be deducted when determining effectively connected income. Here's an example of the liability election. At the end of 2019, Foreign Corp has assets with a basis of $1,000 and $800 of liabilities. At the end of 2020, it also has assets of $1,000 and $800 in liabilities. For 2020, it has effectively connected earnings and profits of $60. Because U.S. net equity has not changed, there is a dividend equivalent amount of $60. Foreign Corp can elect to reduce its U.S. liabilities by $60 to $740, thus increasing U.S. net equity by $60 at the end of 2020 and eliminating the dividend equivalent amount. The cost of the election to Foreign Corp is the loss of the interest deduction associated with the $60 of elective debt reduction. When planning for the branch profits tax, there is an obvious temptation to engage in transactions that artificially increase U.S. net equity so as to avoid the branch profits tax. There are specific rules that prevent this. An asset is excluded from U.S. assets if one of the principal purposes for acquiring or using it is to artificially increase assets. Likewise, if one of the principal purposes for repaying or otherwise decreasing a debt is to artificially decrease U.S. liabilities, then that decrease is disregarded in calculating U.S. net equity. The regulations provide factors to consider in determining whether an asset has been artificially increased or liability has been artificially decreased. When a U.S. income tax treaty applies, the branch profits tax is ordinarily reduced or eliminated. Income tax treaties may both reduce the rate at which the branch profits tax is imposed and the amount of profits subject to the branch profits tax. U.S. income tax treaties may reduce or completely eliminate the branch profits tax. Most reduce the 30% branch profits tax rate to a rate specified in the treaty, or if no rate is specified, to the default treaty rate for dividends paid by a domestic corporation to a corporation resident in the foreign treaty country which wholly owns the domestic corporation. The U.S. Model Income Tax Treaty restricts the branch profits tax rate to 5%, but current bilateral treaties in force all have different provisions. Some bilateral treaties provide for the complete exemption from the branch profits tax. Some provide for a reduced rate of tax. Note that where a treaty itself says nothing about the branch profits tax, which is usually the case, taxpayers can look to the official explanation of the treaty, which sometimes provides specific guidance on the branch profits tax. For example, in the U.S.-France treaty, a discussion of branch profits tax can be found in Article 10 of the Treasury explanation of the treaty. A tax treaty can reduce the amount of profit subject to branch profits tax by restricting the taxable profit to the effectively connected earnings and profits that is attributable to a U.S. permanent establishment. If a foreign corporation qualifies for treaty benefits, the corporation is ordinarily entitled to a potential reduction in the amount of profit subject to the tax. Under this type of provision, branch profits tax is imposed only on the dividend equivalent amount resulting from the effectively connected earnings and profits that is attributable to a permanent establishment in the United States. Here's an example of the effect of a treaty. Foreign Corporation A is engaged in a U.S. trade or business that is also a permanent establishment under the relevant tax treaty. If only effectively connected income is considered in determining effectively connected earnings and profits, A has a dividend equivalent amount of $100. However, if effectively connected earnings and profits is limited to that which is attributable to the PE, then A has a dividend equivalent amount of only $75. Under the treaty, A can elect to calculate the branch profits tax on the $75. In addition, if it elects the treaty, A can pay tax at a lower treaty rate for dividends instead of the default rate of 30%. In general, a foreign corporation must be entitled to apply a treaty before it can lower its branch profits tax using the treaty. In general, for modern treaties, taxpayers are entitled to apply a treaty to lower the branch profits tax if they are qualified persons under the treaty. Qualified person is defined by Article 22 of the U.S. Model Treaty, Limitations on Benefits. See Lecture 4-2 for a discussion of qualified persons. For older treaties, taxpayers are entitled to apply a treaty to lower branch profits tax if they are qualified residents of the treaty country under the rules provided by Reg 1.884-5. These rules are similar to those of Article 22 of the U.S. Model Treaty, but they are not the same. The regulations provide guidance on whether a taxpayer must meet the qualified person test in the treaty or the qualified resident test in the regulations. Special rules apply in calculating the branch profits tax in cases where a U.S. trade or business terminates, where the U.S. trade or business is incorporated into a domestic corporation, or the foreign corporation owning the U.S. trader business liquidates or reorganizes. As discussed earlier, with respect to transactions between a U.S. trader business and a foreign corporate owner of the U.S. trader business, the branch level tax rules attempt to treat the U.S. trader business like a U.S. domestic corporation owned by a foreign corporation. We have already seen that where the assets of a U.S. trader business are withdrawn from a foreign corporation-owned U.S. trader business by decreasing U.S. net equity, a dividend equivalent amount is created that is taxed in a manner similar to a dividend paid to a foreign corporation. As we will see, where there is a termination of a U.S. trader business owned by a foreign corporation, a transfer of such U.S. trader business to a domestic corporation, or a liquidation or reorganization of the foreign corporation, the branch profits tax rules try to achieve a tax result similar to that which would result if the U.S. trader business were a corporation. Let's talk about what happens when a foreign corporation terminates all of its U.S. trades or businesses. A foreign corporation engaged in a U.S. traded business is exempt from the branch profits tax when it terminates all of its U.S. trades or businesses. Any current and accumulated effectively connected earnings and profits is extinguished as a result of a complete termination of all U.S. businesses. The effect of this rule is to exempt a foreign corporation from branch profits tax, even though it reduces its U.S. net equity to zero, which would ordinarily create a dividend equivalent amount equal to the lesser of the decrease in the equity or the prior year untaxed, effectively connected earnings and profits. This rule is in line with the intent of Congress in enacting the branch profits tax, that a foreign corporation doing business in the United States generally should be subject to the same substantive tax rules that apply to a foreign corporation operating in the U.S. through a U.S. subsidiary. The corollary to this rule is Section 331. Under which a foreign corporate owner of a U.S. corporation does not recognize a dividend when the U.S. corporation liquidates and distributes its assets to the foreign corporation. Section 331 provides that amounts received by a shareholder in a distribution and complete liquidation of the corporation are treated as in full payment in exchange for the stock. This rule generally precludes treating such liquidating distributions as dividends. Since a liquidation is not treated as a dividend, then for the sake of parity, the normal branch profits tax rules should not apply to create a dividend equivalent amount subject to the branch profits tax when a U.S. traded business terminates. To qualify for this rule, the foreign corporation must make certain filings and generally cannot directly or indirectly have U.S. assets as of the close of the termination year, use the property of the terminated business in another U.S. trader business for 3 years, or have effectively connected income for 3 years. Under a special rule, the U.S. trader business can continue to treat marketable securities as U.S. assets for a year, thus avoiding a reduction of U.S. net equity, in order to allow it to terminate one U.S. trader business, have a period where it is not operating any U.S. trader business, and then later start a new U.S. trader business without triggering the branch profits tax. Here's an example of the business termination rule. Foreign corp is a country X corporation with accumulated effectively connected earnings and profits of $1,000, which has been engaged in a U.S. trade or business for a number of years. As of the end of 2020, it terminates all of its U.S. trades or businesses by removing all of its U.S. assets and liabilities from the United States and transferring them to country X. Although its U.S. net equity has dropped to zero, it is not subject to the branch profits tax. To be exempt, however, it cannot resume a U.S. trade or business for 3 years. Let us now talk about transferring a U.S. trade or business to a U.S. corporation. Special rules apply where a foreign corporation owning a U.S. trade or business transfers the U.S. assets of that business to a U.S. corporation in a transaction that is tax-free under Section 351. Where this occurs, the complete termination rules discussed earlier do not apply. The dividend equivalent amount of the U.S. trade or business for the year of the Section 351 transaction is determined under normal rules, except that the year-end U.S. net equity is determined without regard to the transfer of assets and liabilities to the corporation under Section 351. The foreign corporation can elect to transfer all or a portion of its effectively connected earnings and profits and accumulated effectively connected earnings and profits to the corporation, thus reducing the amount of effectively connected earnings and profits that can create a dividend equivalent amount for the year of the transfer. If all of the effectively connected earnings and profits and accumulated effectively connected earnings and profits is transferred to the new corporation, then there is no dividend equivalent amount. This election results in the preservation of all of the undistributed earnings and profits, making it possible for them to be taxed as dividends should the corporation make dividend distributions in the future. Here's an example of an incorporation of a U.S. trade or business. Foreign Corporation A operates a U.S. trade or business that has, as of the beginning of 2019, $1,000 in accumulated effectively connected earnings and profits and $5,000 in U.S. net equity. On July 1, 2019, all of the assets are transferred to U.S. Corporation B in a Section 351 transaction. As of the transfer date, there is effectively connected earnings and profits for 2019 of $2,000 and U.S. net equity of $6,000. The $6,000 is transferred to B. Under the normal rules, the U.S. net equity of the U.S. trade or business is reduced to zero, and there is a dividend equivalent amount of $3,000, which is effectively connected earnings and profits of $2,000 plus accumulated effectively connected earnings and profits of $1,000. However, under the special rule, the transfer to B is not taking it into account. Therefore, in calculating the dividend equivalent amount, there is $2,000 of effectively connected earnings and profits, less the $1,000 of increase in U.S. net equity for a dividend equivalent amount of $1,000. The dividend equivalent amount can be reduced or eliminated in this example by electing to transfer effectively connected earnings and profits and accumulated effectively connected earnings and profits to B and thereby increase B's earnings and profits. Where a foreign corporation liquidates or reorganizes, and as a result transfers a U.S. trade or business to another foreign or domestic corporation, the dividend equivalent amount is ordinarily not triggered, and the effectively connected earnings and profits of the transferor carries over to the new corporation. In a transaction described in Section 381 involving the foreign corporate owner of a U.S. trade or business, that is, a corporate liquidation or reorganization, Where the U.S. traded business is transferred from one corporation to another, the complete termination rules discussed earlier do not apply. Instead, the transferee inherits the transferor's U.S. assets and U.S. liabilities. The regulations provide rules for determining the dividend equivalent amount, the effectively connected earnings and profits, accumulated effectively connected earnings and profits, and earnings and profits of the transferor and the transferee. Here's an example of a liquidation of a corporate subsidiary. Foreign Corporation S is a subsidiary of Foreign Corporation P and owns a U.S. traded business. On September 1, 2020, S liquidates under Section 332 and distributes the U.S. traded business to P in a tax-free transaction that qualifies under Section 381. Prior to liquidation, S's USTB had a U.S. net equity of $5,000. For purposes of calculating S's dividend equivalent amount through September 1, the Section 381 transaction is ignored and its U.S. net equity is $5,000. We now turn to the branch interest rules, which recharacterize interest paid by an unincorporated U.S. trader business as interest paid by a corporation. Any interest paid with respect to the booked liabilities of an unincorporated U.S. trader business of a foreign corporation is treated as paid by a U.S. corporation. Under the general rules applicable to non-business income, U.S. tax and withholding may be required if this interest is paid to a foreign taxpayer, corporate or non-corporate, unless one of the interest exemptions applies. As noted above, interest treated as branch interest is interest paid on the U.S. booked liabilities of the U.S. traded business. That is, it is interest that is paid by a foreign corporation with respect to a liability that is a U.S. booked liability under Reg 1.882-5, see Lecture 5-2, other than a U.S. booked liability of a partner. Here's an example of branch interest. Foreign Corporation A has $80 of interest apportioned to the effectively connected income of its U.S. trader business for 2019, all of which is considered branch interest paid to foreign taxpayers. Though actually paid by Foreign Corporation A and not U.S. source income, the branch interest rule characterizes the payments as made by a U.S. corporation. A's payments are as follows: $55 of U.S. source portfolio interest paid to B, a non-resident alien, and $25 of U.S. source interest paid to Foreign Corporation C, which owns 15% of the voting power of A's stock with respect to bonds issued by A. The interest payments made to B are exempt portfolio interest. The payments to C are not portfolio interest because C owns at least 10% of A's voting stock and are therefore subject to U.S. tax and withholding of $7.50, which is $25 times 30%. Finally, let's turn to the tax on excess interest. Where a foreign corporation is engaged in a U.S. traded business or has gross income treated as effectively connected income, interest expense is allocated and apportioned to effectively connected income under the rules at Reg 1.882-5, discussed in Lecture 5-2. Where the allocated and apportioned interest exceeds branch interest paid or treated as paid by the U.S. traded business, The foreign corporation pays tax on the excess amount of interest at a rate of 30% or a lesser treaty rate. The excess interest is taxed in the same manner as if such excess interest were interest paid to the foreign corporation by a wholly owned domestic corporation. Such excess interest is considered paid on the last day of such foreign corporation's taxable year. The regulations provide for some exemptions from the tax, including for certain interest of banks treated as interest on bank deposits. The tax on excess interest is not subject to withholding. Here's an example of the tax on excess interest. Foreign Corporation A has $150 of interest deductions apportioned to effectively connected income of its U.S. trader business. Of this amount, $100 is branch interest paid by the corporation with respect to the U.S. booked liabilities of the U.S. trader business. Because its branch interest of $100 is less than its allocated interest of $150, it has $50 of excess interest. A is treated as receiving payment of this interest on the last day of its tax year, and unless exemption provisions apply, is taxed on this interest at 30% under Section 881 or such lesser rate provided by treaty.